Tuesday, everybody. Some of those concerns on Friday with the jobs report stoked a little bit of stagflation concerns, and that's showing up in the sectors today. So if you take a look, banks are up. We've had rates up. So Goldman's up, J.P. Morgan's up. Rates at the highest levels 10 years since July. Tech's holding in there. Remember, if you get a bit of a cyclical slowdown, moderation in the economy, growth can continue to do well. That's showing up there. Energy's been a poor performer, but it's flat. Industrials have been weak. You see Boeing weak this morning. You see some of the other industrials like Honeywell and 3M also on the weak side. Pretty easy to identify what the risks are for the market post-Labor Day. There's really three of them. The first one, of course, is a growth moderation due to COVID. But so far, the moderation has been manageable. The profit margin decline is a concern out there. We have record margins, about 13%. The concern here is higher wage and material costs. So far, with the exception of some consumer companies, they have been passing the prices along. So that has been manageable as well. Earnings deceleration, we all know about what's going on here. We're at new highs on the earnings, and they keep going up. And, of course, deceleration is an issue, but as of now, that is not happening. If you take a look at the earnings trends, the stuff that matters, that has the biggest margins, keep going up at this point. So if you look at the Q3 numbers here, 29% today for Q3. July 1st, it was 24%. Q4, 21% today. In July, it was 17%. You see, these numbers keep going up for the overall market, and that's the most important thing. As long as these trends keep going up, that's what's going to keep the market holding up. And the right stuff keeps going up. I keep pointing out that if you look at what's accelerating in terms of their estimates for the third and the fourth quarter, technology, communication services, some materials, not all, healthcare and financials. That's an enormous part of the S&P 500. Not everything. Consumer staples and industrials are not seeing any real acceleration in earnings at this point. And consumer discretionary, and particularly retail, there's something that we're actually seeing estimates starting to decline a little bit as a lot of enthusiasm about buying in the retail sector is abating due to concerns about COVID pulling back. But overall, very, very large parts of the overall S&P 500 are continuing to see acceleration in earnings. And you can see this in what actually is going on. If you just look at the price action, you can see so far this quarter, two months out of the three gone, healthcare and technology, these are the growth sectors, are continuing to see the biggest move up. So growth is doing better than cyclicals, which would be industrials and energy. This makes a lot of sense if you're in what we call a mid-cycle recovery, where you continue to do well, you still have some growth. Reliable growth stocks do better, but cyclical sectors like industrials and energy, they tend to falter. So far, this has almost been a textbook mid-cycle recovery. I think the important thing right now is just keeping an eye on those earnings situations. And right now, no deceleration. Carl, back to you.
All right, Bob, thanks. Bob Pisani.